About using AI to help us with our investment decisions. I'm not talking about investing in AI companies, but using AI to invest. I'm seeing more and more platforms pop up claiming that AI can beat the market, predict the next big stock, or manage a portfolio better than any human. In this video, we're going to look at how AI is changing the investment landscape, what it means for us regular investors, and whether it could eventually put traditional fund managers out of a job. So first, let's look at what's actually happening right now. AI investing isn't exactly brand new. You have hedge funds such as Renaissance Technology who've been using sophisticated algorithms for decades. But what has changed is accessibility. Today, you've got robo-advisors like Nutmeg and Monzo offering AI-driven portfolio management. You've got trading apps using AI for market analysis and recommendations. AI chatbots that can analyze your spending and suggest investment strategies. And even traditional brokers like Hargreaves Lansdown incorporating AI-driven insights. The difference is now this is not just available for those billionaire hedge funds. It's available for regular investors like us with modest portfolios. But here's the thing, there's a massive difference between AI helping with basic portfolio allocation and AI that's trying to predict individual stock movements. And understanding the difference is crucial. Let me start with the positives because there generally are some compelling benefits to using AI for investing. Speed and data processing. AI can process massive amounts of data in seconds. It could be company reports, market trends, news sentiment, even social media chatter. While I'm still reading through one quarterly report, AI has analysed hundreds and potentially spotted patterns that I'd never see. Emotion-free decisions. This one is huge. How many times have you held on to a losing investment because you believed in it or you panic sold during a dip? AI doesn't have emotions. It doesn't get scared, it doesn't get greedy, and it doesn't get attached to a particular investment. 24/7 market monitoring. This one's more for the active investor, but markets never sleep and you might miss an opportunity while you're sleeping, while you're off doing something else. AI doesn't need to sleep. It can be constantly running in the background, whether it's analyzing data, looking for opportunities, or even getting you out of an investment. You might have 2 or more investment strategies that you can't choose between, and they might be very close. With AI, you can use backtesting to look over decades of previous data to analyze what would have happened in the past. That might help you to identify patterns that you might not have seen otherwise. Cost efficiency. AI has the potential to dramatically lower investment fees. Instead of paying 1 to 2% to a human fund manager, you got robo-advisors charging as little as 0.25%. Personalization at scale. A lot of what we've looked at so far is with fund management and the actual investing. But this could also have a massive impact on financial planning and financial advisors. AI has the potential to create personalized investment strategies based on your specific goals, your risk tolerance, and your financial situation. Something that might cost a fortune going to a human advisor. But before you rush off and let AI manage all of your money, we need to talk about the real risks and the limitations here. The black box problem. Many AI systems are like black boxes. They give you recommendations, but you can't fully understand how they've got to that recommendation. That's not necessarily a problem on its own. It's a little bit like going to the doctor and they tell you what you need to do. You might not fully understand how they've come to that conclusion, but you believe them and you take their word because of the credibility that they've built up through their qualification and their work. And it's a little bit similar to AI. You don't necessarily need to fully understand exactly how it's come to that conclusion, but you need to ask yourself, how comfortable are you taking the word of this AI and how credible is the source? Historical data bias. This is just like humans. AI only can rely on historical data, and markets can change in unprecedented ways that no one could have predicted. The pandemic is a perfect example of this. It changed the markets and moved them in ways that nobody could have predicted. You also have overfitting and false patterns. AI might identify patterns that look significant, but are actually just statistical noise. For example, it might identify that Tuesday is the best day to invest, when in fact that's just a coincidence. There's of course technology risks. We have to ask ourselves, what happens if the technology fails, if there's a bug or it gets hacked? There have been flash crashes caused by algorithms trading the wrong way in the past, so we have to be aware of what safeguards are in place. There could be a crowding effect, so if an AI starts to outperform others, it could become more popular, and the more people that start to use it, especially in smaller markets, that potentially could then have the power to move that market, and that could create immense volatility. If it's set to buy a certain investment at a certain point and everyone is doing exactly the same thing, well, that could then massively move the market, which you could also argue is slightly unethical, but it's also not healthy for a market as well. And there's always going to be that lack of human judgment. It could be difficult for AI to factor in upcoming regulatory changes to political personnel, changes to geopolitical events and environmental changes. Those kind of changes will always require some form of human intuition and experience. Now, here's where it gets really interesting for the future of the investment industry. If AI becomes good enough, what happens to your traditional fund manager? I think in reality, this is already happening. Passive investing has already overtaken active investing in recent years, and that's without AI. I think AI now is accelerating that trend. Why pay an active fund manager 1.5% when an AI-driven tool can deliver similar or better returns for a fraction of the cost? So I don't think it's all game over for human fund managers just yet. I think it comes down to how much they can adapt and actually use AI to their advantage. They can use AI to enhance their analysis rather than replace their judgment, while still focusing on the areas that human insight can be beneficial, such as focusing on specific areas of investing or understanding regulatory change or even spotting emerging trends. And that's where there's a balance still to be had, using AI to enhance, but still providing that human touch that many investors want, especially during times of market crises. So how should you actually approach this as an investor? The first is start small and keep it simple. Don't put your whole portfolio into a new AI investment strategy. Test it out with just a small portion of your portfolio, or even if you have a few different strategies lined up, you might want to spread your bets a little bit. Understand what you're buying. Now, you don't need to have the intricate detail of how it's come to a certain decision or how it's put together its market analysis, but you want to have a rough understanding and look for platforms that are very transparent with the methodology. This is going to be a constantly evolving technology, so we have to keep learning. What works right now could be completely different advice in 12 months' time. There's of course going to be general principles which we can always stick to long term, but especially with a new technology like this, we have to keep our finger on the pulse. We can't get attached to one certain AI strategy, and we have to be willing to change. At the same time as striking that balance of not just jumping on any new trend that comes our way. And that's what's going to make this very difficult in the next few years, because there's going to be a lot of opportunities, almost too many opportunities for us to choose between. And sometimes simple is going to be best. And in other cases, we might need more of a nuanced approach. And I really want to stress that point about this doesn't change the fundamentals. Still having a long-term approach with investing money that you don't need for a long period of time. Your risk tolerance, again, doesn't change. And your diversification principles also shouldn't change as well. And that's all about not putting all of your eggs into one basket. So you shouldn't see this as something to be scared about or worried about, or that you're going to miss out if you don't fully understand, because those key principles will always be in there. And that's what's going to make up the majority of the performance you get on your investments. This is just that extra few percent that might either make it a little bit cheaper or get you those few extra percentage points. And on that point about cheaper, AI doesn't always mean it's going to be cheaper. There's going to be platform fees potentially involved with some of these AI strategies. So just be aware and make sure you've done enough due diligence to make sure you know exactly what you're paying and to who you're paying it to. Looking ahead, I think AI will continue to evolve. I think it will become increasingly sophisticated and accessible. And these are a few things which I think we might see. I think we'll start to see AI explaining its reasoning in more plain English. I think there'll be better integration between AI analysis and human oversight. We could see more specialized AI tools for specific types of investing. Maybe it's growth, could be value, ESG. And I think AI will continue to adapt more quickly to changing market conditions. But I also think we'll start to see more regulation from governments. And along with that, we're likely to see some high profile failures. That's going to remind us that AI isn't foolproof. Key is to stay informed, but remain skeptical of bold claims. If something seems too good to be true, then it probably is, whether it's made with AI or not. So is AI changing the way that we should invest? Absolutely. But it's not all about replacing human judgment entirely. It's about using these tools wisely as part of a broader investment strategy. I think the future probably isn't AI versus human. It's AI working alongside human insight and oversight. And the investors who succeed will likely be the ones who can use these tools effectively while also understanding its limitations. What's your experience with AI investing tools? Have you tried any robo-advisors or AI-powered investment platforms? Let me know in the comments down below. And if you found this useful, don't forget to like and subscribe. It really helps the channel grow. If you want to find out how you can create your own DIY global index fund that's cheaper than the typical fund, then check out this video here. Thanks for watching, guys. I'll catch you in the next one.